Hi, Srinivas here. Welcome back to VJS Academy Stock Market Techno Fundamental Analysis course. In the previous video, we have discussed about advantages of stock market, the kind of attitude every stock market trader should have. Follow them strictly. Quickly go through the disclaimer. So now in this video, we are going to learn about the basic components of the stock market. What is share, what is stock market, what is cash market, what is derivatives market, all those things we are going to learn in this video. What is share? A share is one of the equal parts of a company. When a company wants to raise capital for their business expansion or for new projects, they go for public issue. For example, you have started a company, XYZ company, with 10 crores. For your business expansion, you need another 90 crores, but you don't have money and you can't borrow from your friends or relatives. So then, how do you expand your business? In this case, you ask public to invest in your company as a shareholder, but you can't directly ask them. You can personally ask your friends and relatives to borrow money, but whereas if you want to go to the public, you need to go through initial public offer. To raise remaining 90 crores of fund, first you will approach SEBI. SEBI need to give you permission to go to the IPO, initial public offer. Once they are satisfied with your reports and if they give you permission to go for IPO, through exchanges you issue your shares. Say for example, if the face value is 10 rupees of each one share, you are going to issue 9 crores of shares to raise 90 crores of capital. So along with your capital, your company's worth will go up to 100 crores. So once you issue your shares to the public, all those public will become shareholders of your company and those shareholders will be shared the company's profits, if any, in the form of dividend. And all those shareholders will have questioning rights and voting rights. So what is share market? Share market is the place where shares are bought and sold. Stock market is a place where along with shares, bonds, mutual funds, derivatives contracts are bought and sold. Okay, so now we are talking about stock market. So if you want to buy or sell shares, actually we have two kind of markets, primary market and secondary market. As we discussed previously, if you want to go to public issue, you approach SEBI and you issue your shares through exchanges. So that is called initial public offer and that is primary market. And secondary markets, once your issue is closed, after that if any public want to buy or sell shares, they need to participate in secondary market. So only initial public offer IPO is in primary market. After that shares are being bought and sold in the secondary market. Why people buy and sell shares? As we discussed, you started your company with 100 crores after public issue and in the next year if you can make 20 crores profit and in the annual general body meeting you announce your profit. When you announce your profits, people are interested to buy your shares, but they can't buy shares directly from your company. In this case, they approach your shareholders already who bought. For example, one of my neighbors bought your company shares. Now I approach him. I want to buy XYZ company shares. Can you sell them to me? If he wants to sell his shares, there should be a reason because already your company shares are giving profit. So why should he sell your company shares? There should be a reason. Usually when we share our property, when you want money or when you doubt price will go down or when you make profit. In these three conditions only you want to sell your property. In this case, shares are your property. So forget about the money necessary. So in this case, you want to sell when you doubt that market will go down or when you make profit. So in this case, if I want to buy shares from my neighbor, I need to offer him a better price, which means, say for example, previously he bought your shares at 10 rupees. Now after your profit it become 12 rupees. I need to offer him a better price. Say for example 12 rupee 50 paisa, 12 rupee 30 paisa. Of course, usually in the market we can't offer directly 50 paisa or something like this. In the market 5 paisa is the minimum increase or decrease. So even if I can offer 12 rupee 5 paisa also, if he satisfies, he will sell me the shares. Otherwise, he won't. So this is way people participate in the secondary market. So where we can buy or sell shares. When it comes to equity, mainly in India, Bombay Stock Exchange, Worldest One and National Stock Exchange, BSE and NSE are there. Most of the companies are registered with BSE and NSE, okay, in which NSE is more popular nowadays. So if you want to enter into the market, you need to open an account with any broker. Actually, this is the hierarchy. First, SEBI will be there. SEBI will control all those things. Exchanges will be there, but you can't open your account directly with exchanges, so that they recruit brokers. So we need to open accounts with broker. So broker is the mediator in between exchange and trader. So whenever you want, you can buy or sell shares in these exchanges through the brokers. Okay. So you are ready to enter into the stock market. So what you should do? In stock market, mainly there are two types of markets: cash market and derivatives market. Previously, only cash market was there. After that, derivatives market has been introduced. Cash market means directly you can buy or sell shares of any company. That is cash market. But later on, derivatives market has been introduced. Actually, derivatives market is a hedging product for the cash market, which means, say for example, you have 1000 shares of a company. You bought them at 100 rupees and the price has been increased to 150 rupees. After that, you feel like price may go down. If price goes down, what will happen? Your profit will go off. And if you want to take that profit, you need to sell your shares. But you are keeping those shares for a long time and you don't want to sell those shares. In this case, to protect your profits, derivatives market has been introduced as a hedging product. In derivatives market, futures and options are there. Options, we will discuss about them later on. First, we will discuss about futures. These futures contract have been adapted from the agricultural farmers actually. Say for example, one farmer is cropping cotton. So, say for example, at present cotton rate is around 4000 rupees. But after getting the yield, the market price may go down or go higher. In this case, farmer wants to protect his profits. So say for example, one business person is there. Directly he approaches the farmer and he will make a contract, like say for example, after 3 months crop will come. After 3 months, I will buy all your cotton at 4500 rupees. That particular business person will give the agreement. If farmer agrees to that price, they will have a contract. After getting that crop, whatever the price it may be, that business person has to pay 4500 per ton. Whether it is 4000 rupees at that point of time or 5000 rupees, he need to pay only 4500 rupees. In this way, the farmer is protecting his profits from ups and lows of the market price. That is called futures contract. Here, that particular business person is a seller or writer of the contract. This farmer is the buyer of the contract. Okay. The same concept has been adapted from agriculture to stock market. The same way in cash market, the persons who are having stocks, and if they doubt that market may go down, they will sell futures contracts. Okay, we will discuss more about futures later on. So in cash market, you can buy any number of shares, even it is one number or 100 numbers or 1000 numbers or 1 lakh shares. You can buy any number of shares, you can buy. And you can take the delivery of those shares. Previously, people used to get physical certificates Now demat accounts are introduced, so those shares will be deposited into your demat account and you can hold them as long as you want, even if it is 1 day or 1 week, 1 month, 1 year or 10 years. As long as you want, you can hold them, and you are the shareholder of the company. You will have questioning rights, you will have voting rights, and you will have the eligibility for the dividend also. In derivatives market, you can buy or sell contracts in lots only. You cannot buy or sell in one unit, 2 units, or something like this. And delivery is not possible here. Those positions will be closed on the expiry day of the contract. I will tell you what is expiry day. So in this case, you can't buy or sell 1 or 2 shares. You need to buy them in contracts, lots only. Lot size is variable in between stocks. According to the stock value, lot size will be decided by the exchanges. Okay, so now we will discuss about contracts. Mainly in India, we have 3 types of contracts: 1 month contract, 2 month contract, and 3 months contract. When you buy or sell any futures contract, they may expire in 1 month, or in 2 months, or in 3 months. So what is the expiry day? Expiry means 1 month contract means it is not from day to day. Say for example, today is 3rd. So expiry will not be the next month 3rd. Every month, last working Thursday is the expiry day. Remember, last working Thursday. This month, 30th is the last working Thursday. So that for July 2020, expiry date is 30th. If last Thursday is a holiday, before working day is the closing day. And the new contract opening day is next working day. Say for example, 30th is the expiry day of the contract. So Friday is going to be the new day for the next contract. But if Friday is a holiday, next working day will be the opening day. Once again, in the future videos, we will learn more about futures and options. Now we will discuss about the advantages of the stock market. As we discussed in the previous video, opportunity to get more returns on our investment compared to bank FDs, postal savings, bonds, and mutual funds. Liquidity. You can close your positions anytime in the market hours, and you have more opportunities. If you have good knowledge on the market, you can make profits while market is growing, while market is falling, and even while market is sleeping also. Sleeping means when the market is moving sideways. At that point of time also you can make money. And you have the comfort of working from your home itself. And another advantage is, usually brokers provide 1:5 to 1:10 leverage also. We will talk about leverage in the later videos, but as of now, leverage is a double-edged sword. You can make higher profits, or there is a chance of high risk also. But still, it is an advantage to make more money in the market. Disadvantages, as I told you, risk factor. There are many factors affect the market. If you are not aware of them, you will end up losing your money. And emotions. It is not easy to control the emotions. Controlling the emotions is the most important factor in the financial market. Of course, I put this controlling emotions in the disadvantages, but if you are able to control your emotions, this is an advantage actually. Controlling emotions are not applicable only in the stock market. In your personal life, in your social life also, if you can control your emotions, they will help you a lot. So if you are able to control your emotions, this is an advantage itself actually. Okay. So in this video, we discussed about what is share market, what is stock market, and what are the market types and all. In the next video, we will discuss about some more basic components of the stock market. Thank you. Bye-bye.